looking at the Couch Investing's portfolio performance week over week compared to the S&P 500, it's basically even. Now we know that in the past month or so, this portfolio with these types of stocks did outperform. We're up 8%, whereas the S&P 500 is not even up 1%. But of course, we know that if we compare it since the start of this challenge, so yes, you can see here year to date, but this is not year to date for S&P 500. This is including when I started this challenge and this portfolio. The portfolio is up 4.1%, whereas the S&P 500 is up 10.5%. And this is despite Tesla being up 32.7%, Palantir being up 25.5%, Google being up closer to 28%. Now, of course, there are some other heavy bags, let's say, even though not that heavy, let's be honest. PayPal is my second largest position in this portfolio, and actually it's a pretty large position in my main portfolio. But here, the stock has not been doing anything at all. So my second largest position is dragging the performance down a little bit. The third largest, which is SoFi, is actually overall down just 1.7%. So again, the number 2 and the number 3 are still to move, or at least contribute to the portfolio in a meaningful way, despite some other positions a bit lower, not that low. Number 4, number 5 have been performing quite well. Some others not so much, but I still have some cash left to allocate accordingly. Earnings season, so I do expect some volatility in this portfolio. And over the long run, I still think that even if I don't sell any positions, I will probably sell some that were in the portfolio only for the short run because they were hit quite heavily. Some of them were hit quite heavily even after I bought them. But okay, we live and you learn. I still believe that this group will outperform in the long run. I already know that some of you will ask me about Celsius, will ask me about Lululemon. Celsius under $50. I'm still watching. No reason to jump in and add a bit more, even though I am down 25% since I bought some shares. Only 2% of the portfolio, so I have time. I'm willing to wait for the next earnings report and earnings call to hear a bit more commentary on that. And so before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. We're very close to reaching 50,000 subscribers. I really appreciate all of the support. Now let's start with the main topic of this video, which of course is the stock market during an election year or just after. So the 4-year United States presidential election cycle is a theory that the stock market are weakest in the year following the election of a new US president. So is that true? Is that theory actually correct? Or is it just a theory? Well, as you can see here, 8 decades of election returns. You can pause the screen and look at all of the results if you want, but if we look at year after election, there are way more years where the market is up than when the market is down. Of course, you have years like 2000, 2008, where you had some volatility, where either something happened right before or right after. For 2008, for example, pre-election, it's down 34%, full year election, 38.5%, but year after election, 23.5%, despite the economy not actually recovering just yet. You have to know that the stock market recovers before the economy. And then if we look at the median, pre-election, January to October, market is up 5.6%, full year election year, market is up 10.7%, then year after election, median here 9.8%. So it's safe to say that that theory stays a theory, and a pretty bad one. Then a little bit more information here for you, although these numbers don't include 2020 to 2024. These stopped at 2019. So this is the presidential election years throughout history. You can see here the stocks and the bonds. New president is elected, all presidential election years, and incumbent president wins. So if history tells us something, is that the market prefers if the president stays the president. Why is that? Well, because the market already knows the policies, knows the agenda, and so there are no, let's say, unprepared shocks coming their way. On the flip side, it truly depends on the president and the situation that we're in. Now, here we have the certain subjects that Republicans and Democrats have different views on. with regards to the stock market and the economy. Might be boring for some, might be interesting for others. If you want, you can skip through this part. So we've got taxation, regulation, government spending, trade policies, energy policies, economic principles, and workers' protections. So I'm going to touch on taxation, regulation, government spending, and trade policies, because I do think that those are, let's say, more relevant, more important, especially for this video, but you can pause the screen and read the rest. So taxation. Republicans advocate for tax cuts for individuals and corporations, believe in lower taxes to increase disposable income and investment. As for Democratic perspective here, support progressive taxation, higher taxes on wealthy individuals and corporations to fund social programs and infrastructure. Regulation. Republican support the regulation to allow businesses to operate freely and efficiently. Democrat favor more regulation to prevent abuses, protect customers, and ensure economic stability. Moving to government spending, Republicans prioritize reducing government spending and budget deficit, cuts to social programs and public expenditures, although government spending under Republican and Democrat in the last couple of years have been quite out of line, but okay. Democratic perspective advocate for increased government spending on social programs, education, and infrastructure. The last one here, I want to touch on trade policies. Republicans support free trade agreements but endorse protectionist measures for American workers and industries when necessary. We've seen that more recently with comments on Taiwan and China. Democratic perspective here favor fair trade policies that protect workers' rights and the environment. So yeah, you might say that businesses, stock market would benefit from Republican perspectives. But let's dive a little bit deeper. So historical election outcome scenarios and market performances. If you've got a White House under a Democrat or a Republican, and then a Congress control under a Democrat or a Republican, or a mix of both, you see here the outcome, you see the average 3-month S&P 500 return and the average 3-month return relative to all periods, and then you see if statistically it's significant or not. Most cases, no. Where is it significant? Let's say that's when a Democrat is in the White House, Republican controls the Congress, or a Democrat in the White House, and then you've got Congress control, which is a bit mixed. And then the last one is Republican in the White House and a Democrat-controlled Congress. But here we start to conclude a little bit what I want to say in this video and what you should learn and never forget. So here is the growth of a dollar invested in the S&P 500 from January 1926 to December 2019. You can clearly see that over the long run, it does not matter if it's a Republican or a Democrat in the White House. Yes, there are some periods of ups and downs, but it has more to do with macroeconomic things than who's in the White House. Of course, the guy in the White House can cause macroeconomic uncertainties, disasters, conflicts, you name it. But as you can clearly see here over the long run, I mean, this is close to 100 years. It's going up. Your dollar invested has gone up, and despite inflation ruining your buying powers, by investing you are actually safe and actually making money. Now there was something else I found which again gives us a little bit more information, but here as well it's a bit outdated. It's up until 2017. So you see what happens with the S&P 500, the average S&P 500 price performance when the incumbent party won and when the incumbent party lost, all from 6 months prior to 1 year after the election. But what decides, what actually will have a much bigger factor, a much bigger impact on your portfolio and on the stock market? That's, well, rising growth, falling growth, rising inflation, falling inflation, rising growth with falling inflation, or falling growth and rising inflation. All of those will and have statistically a significant impact. Why is that? Because like I said, doesn't really matter, especially not, I would say, in the United States. Maybe yes, in a dictatorship, in a communist country, stuff like that, then yes, maybe the dictator does dictate what happens with the stock market in your portfolio. But the whole premise of having an open economy, free markets, is so that one president, one person will not completely change everything. Also, the president does not decide everything. Things have to pass the House, has to pass the Senate, things are on the federal level, things are on the state level. There's a whole thing going on there in the United States. So, most important here is actually the economy, not the guy in the White House. So I think that by now you should understand that there are many other factors out there that will impact your portfolio, will impact the stock market. That is not just the election. What happens just before the election? What happens just after the election? Yes, a president has a certain agenda. Yes, a party has a certain agenda. But as you've seen, over the long run, the stock market is doing fine. Over the long run, good companies will survive no matter who's in the White House. And so the focus, I would say, in the short run should be on inflation. Is inflation falling fast enough? Are interest rates going to fall fast enough? Are we going to a recession? Yes or no? Looking at your companies, earnings going up, margins going up, or earnings going down, margins going down. Consumer demand, consumer spending, all of that, those are more important factors than just focusing on what the media tells you, focusing on, oh, Trump presidency will do this, or Biden presidency will do this, or Gavin Newsom presidency will do that, or an Obama presidency will do this, etc., etc. Focus on what you have in your portfolio, and then maybe when suddenly there are some drastic policy changes, then you can maybe start to think and see how that might impact a company that you hold. For example, car companies, EVs, hybrids, etc., etc., incentives, subsidies by the government. You can see how that might impact your company positively or negatively. And so overall, switching back to the portfolio, I think for me personally, it doesn't really matter what will happen if it's a Republican or a Democrat in the White House. I do still think that these companies will perform regardless of who's in the White House. Yes, maybe, for example, with regards to SoFi, the loan business, yes, took a hit because of the loan forgiveness program, but this is something that will end sooner rather than later, although I've been saying this for quite a while, but I do still think that there is the light at the end of the tunnel. So that's about it for this video. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.